Accounting principles help to fill the gap and focus to bring some level of standardization in financial reporting. If each business makes the financial statement in their method, then there will be an enormous amount of financial statement formats trying to reflect similar information. It becomes almost unachievable for a business to compare and understand the statements of other companies. As an outcome, financial data becomes incomparable and difficult to understand. Accounting principles include the accounting concepts and conventions that help to understand the financial statements and help the management to make reliable decisions. Accounting is an important part of every business, irrespective of the size of the business entity. With the business requirements of modern times, business and accounting go hand in hand. They cannot function without each other. By recording all the financial transactions, accounting helps in ascertaining the financial performance of the business by preparing financial statements. These financial statements are used by both internal stakeholders as well as external stakeholders like the investors, tax authorities, regulators, banks, and other users. The accounting principle states the common rules or regulations for recording financial transactions and making financial statements. Accounting principles are the initial guidelines for recording and preparing financial statements. The accounting principles are generally termed as Generally Accepted Accounting Principles or simply GAAP. Accounting principles help to convey standardization in accounting and preparing financial statements, and it is applied worldwide. The supervisors and authorities of every country may have their accounting principles like UK GAAP, US GAAP, INAS, IFRS, and others, but at the central, the fundamentals and objectives of accounting principles continue to be the same. Accounting principles are accepted if they are objective, operational and practical circumstances, dependable, economical, in the sense that they can be applied without suffering high costs, and logical to those with a minimum required knowledge in finance. There are certain basic principles of accounting that are to be kept in mind while preparing financial statements. Following are discussed below. This principle needs the companies to keep a track of the goods purchased, services rendered, or capital assets acquired at the price expended for them. Assets are then recorded on the balance sheet at their historical cost, without adjusting them for the changes in the market value of these assets. Revenue recognition principle. This principle needs the companies to record their income or revenue as in when it is earned instead of when it is received. This accrual basis of accounting provides a more precise presentation of financial events that occurred during the accounting period. Matching principle. This principle mentions that all the expenses must be matched and recorded with their particular revenues at the time that they were experienced instead of when they were spent. This principle coordinates with the principle of revenue recognition, confirming that all incomes and expenses are recorded on an accrual basis. Disclosure principle. This principle necessitates that any information that would significantly affect the decision of the user of financial statements about the company must be disclosed in the form of notes in the financial statements. This restricts the companies from misappropriating significant information about accounting practices or non-possibilities in the future. Cost-benefit principle. This principle binds the essential amount of research and time to record or account for the financial information if the cost crosses over the benefit. Therefore, if recording an insignificant event costs the company a substantial amount of money, it should not be recorded in the books. Conservatism principle. It is the principle that shows the general idea of identifying expenses and liabilities as soon as possible when there is doubt about the result, but to only identify revenues and assets when they are confident of being received. Objectivity principle. Under this principle, the financial statements, records of accounts, and financial information as a total should be not dependent and free from biases. The financial statements are intended to show the financial position of the company and not to influence the end users to take appropriate actions. Consistency principle. This principle mentions that all accounting principles and traditions should be functional steadily from one period to the other. This guarantees that financial statements can be compared between different stages and during the past of the company.